I welcome you all to another exciting video. My name is Olga, and in today's video, I'm going to talk about practical tips on saving money on income taxes in Uganda, from deductions to credits. So stay tuned for more valuable insights on how to optimize your tax situation, and don't forget to subscribe to our channel. Turn on that bell icon so you don't miss out on any of our latest videos. So, tax planning is an exercise undertaken to minimize tax liability through the best use of all available allowances, deductions, exclusions, exemptions to reduce tax. So, if you're an employer or an employee in Uganda, you may be looking for ways to lower your tax burden and increase your savings. One of the ways to do that is to make use of the tax exemptions and deductions that are available for certain benefits that you can provide or receive as part of your employment contract. So in this video, we'll discuss some of the most common payroll tax planning issues in Uganda and how you can benefit from them. So number one is filing of tax returns. Filing of income tax returns and paying all taxes due by the due dates enables a taxpayer to minimize penalties that would arise on late filing of returns or late payments of tax. Additionally, filing tax returns on time can reduce the risk of default assessments, tax audits, and disputes. Next, we have medical expenses. If you provide medical insurance uh, for your employees, the tax law allows you to deduct the cost of the insurance from your taxable income. Likewise, if you are an employee and receive medical insurance from your employer, the value of the benefit is excluded from your gross income as long as the expenses are for yourself or your spouse or your dependents. This way, you can save money on your income tax and also protect your health. Number three is meals and refreshments. If you provide meals or refreshments for your employees on your business premises, you can deduct the cost of the food and beverages from your taxable income. Similarly, if you are an employee and receive meals or refreshments from your employer on the business premises, you can exclude the value of the benefits from your gross income. However, this exclusion only applies if the meals or refreshments are provided to all full-time employees or on equal basis and are on lavish or extravagant. Number four, we have retirement fund. If you provide a retirement fund for your employees, such as NSSF, you can deduct the contributions to make to the fund from your taxable income. Likewise, if you're an employee and contribute to a retirement fund provided by your employer, you can exclude the contributions from your gross income up to 5%. This way, you can save money on your income tax and also build up your retirement savings. Number five, we have official employment expenditure. If you incur any expenses related to your official duties, such as travel, entertainment, meals, you may be able to deduct from your taxable income. However, you have to meet certain conditions and keep proper records to claim this deduction. In addition, number six, we have loans and advances. In regard to loans and advances, the employer lender and employee borrower should consider the interest rate and the repayment period of the loan or advance in question. According to the Tax Income Act of Uganda, any loan or advance given by an employer is an employee to an employee is treated as a taxable benefit in kind unless the interest rate charged on the loan is equal to or higher than the Bank of Uganda discount rate, or the loan is repaid within 3 months. So, to avoid paying tax on the loan or advance, the employee and employer should either agree on an interest rate that meets or exceeds the Bank of Uganda discount rate, or ensure that the loan is repaid within 3 months of receiving it. Then we have terminal benefits. If you provide terminal benefits for your employees to retire or leave your service due to death or disability or any other unfortunate thing that can happen, you can deduct the cost of the benefits from your taxable income. However, if you are an employee and receive terminal benefits from your employer due to retirement or termination of service, you may have to include part or all of the value of the benefit in your gross income. Then we have private use of motor vehicle. In regard to private use of motor vehicle, the employer and employee are encouraged to keep a logbook of the vehicle usage. Logbook can help you distinguish between business and private use of vehicle, and to allocate the appropriate amount of income tax to the employee arising out of use of the motor vehicle for private purposes. In Uganda, the value of the benefit forms part of the employee chargeable income. However, if the employer can provide can prove that the vehicle is used for business purposes, the benefit in kind does not arise. There, keeping a logbook can help you reduce the tax liability for both the employer and the employee. And then we have shares. If you provide shares or stock options for your employees, you may be able to deduct the cost of the shares or options from your taxable income. However, if you're an employee and receive shares or stock options from your employer, you may have to include the value of the benefits in your gross income, depending on when and how you exercise or sell the shares or options. Therefore, if Therefore, it is important to consult with a tax professional before accepting this benefit. Next, we have life insurance. If you provide life insurance for your employee, you can deduct the premiums you pay for the insurance from your taxable income. However, if you're an employee and receive life insurance from your employer, you may have to include the value of the benefits in your gross income depending on the type and the amount of the coverage. Therefore, it is important to check with your employer or a tax professional before accepting this benefit. And lastly, we have pension. If you provide a pension plan for your employees, you can deduct the contributions you make to the plan income from your taxable income up to a limit of 30% of your gross income. Similarly, if you are an employee and contribute to a pension plan, you can exclude the contributions from your gross income up to the same limit. This way you can save money on your income tax and also secure your retirement income. That is for today. If you found this video helpful and informative, please give it a thumbs up and don't forget to subscribe to our channel. I'll see you in my next video.